Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Macro to micro, Fed pressures and the tale of two AI markets. This video presents a direct, informational narration of the source document. Today, we're breaking down an analysis of recent market dynamics, taking a look at the exact data driving these massive shifts from the macro level all the way down to the micro.
Here's our agenda for today's explainer. First, we'll start with how the Fed reversed the market, then look at the new pressures facing semiconductors. After that, we'll navigate the broad indexes, dive into Meta's expensive AI gamble, and finally, wrap up with how Microsoft is winning the AI race.
Part 1. The Fed reverses the market. So, we're going to start at the macro layer. The Federal Reserve's latest interest rate decision initially sparked some optimism, right? But then, it quickly turned into this massive late-day sell-off. Just look at this timeline. At exactly 2 p.m., the Fed holds rates steady with a 9-3 vote, and the market reaction was actually positive. But then, 2:30 p.m. hits, and Christopher Waller's press conference begins. Because he totally avoided giving clear forward guidance and kinda downplayed the June CPI report, the bond market just reacted aggressively. Literally, by 3 p.m., the 10-year and 30-year Treasury yield spiked. That instantly crushed those earlier equity gains, and by 3:15 p.m., it severely punished high-growth equities, especially those with negative earnings per share.
You can see exactly how sudden this macroeconomic shift was by looking at the VIX. The volatility index absolutely surged, breaking right above that critical 20 level. This is a classic signal, brilliantly illustrating a rapid, market-wide rush into risk aversion. The data really makes one thing crystal clear for us. The market is hypersensitive to interest rates right now. If those Treasury yields stay elevated, the valuations of these high-growth tech stocks are absolutely going to face severe downward pressure.
Moving on to Part 2. Semiconductors face new pressures. Drilling down to the sector level, this whole macro sell-off aggressively interrupted what looked like it was shaping up to be a nice technical rebound for semiconductors. The index actually opened poorly, breaking right below the 489 mark. Now, it did manage a brief 5% intraday rally, bouncing off the 465 support level, which showed us there were definitely eager buyers stepping in. But it ultimately surrendered to that broader post-3 p.m. market slide we just talked about. Because of that brutal late drop, those new buyers are now totally trapped. The index breached a vital support zone between 489 and 532, which basically means semiconductors are now caught between internal sector resistance and broad market selling pressure.
Which brings us to Part 3. Navigating the broad indexes.
So, with the semiconductor sector acting as a heavyweight dragging things down, all eyes are on whether the broader market indexes can actually hold their structural support levels. For investors who are looking to find some excess returns during a pullback, knowing exactly where that structural support lies is absolutely crucial. Let's look at the numbers here. The SPY closed near 720.90, and it's looking right toward its 200-day moving average. That's the 676 to 695 zone as its primary support. Meanwhile, the QQQ closed at 661.0. That means it has literally already entered its first target support zone of 645 to 65. As the broader market dips, these specific zones are the critical areas we need to be watching.
Okay, let's zoom in a bit and move to the micro, corporate layer to see how this builds into individual company performance. Right now, we're seeing this stark, really fascinating divergence in fundamental outcomes between two giants, Meta and Microsoft. Specifically, we're looking at how smoothly their massive AI investments are actually translating into immediate cash and profitability.
Part 4. Meta's expensive AI gamble.
When you examine Meta's second quarter results, you see a company that is burning immense amounts of capital to fund an AI future that just hasn't quite hit the bottom line yet. I mean, not only did Meta almost double its Q2 capital expenditures, but they also raised the lower bound of their fiscal year 2026 CapEx guidance by $5 billion. That pushes their revised range up to somewhere between $130 billion and $145 billion. This signals a continued massive cash burn with negative free cash flow.
And the financial impact of all this spending is immediately visible. Despite a top-line revenue beat of $60.8 billion, which beat the $60.2 billion estimate and represents a solid 28% year-over-year increase, their operating margins completely collapsed, dropping from 43% down to just 31%.
This 12% margin drop led to a significant earnings miss, coming in at $6.18 per share versus the $7.19 estimate. Combined with weak third-quarter forward guidance at a $62.5 billion midpoint, which missed the $63.17 billion estimate, this narrative of delayed AI monetization caused a sharp after-hours drop in Meta stock.
Now, let's contrast that with Part 5. Microsoft wins the AI race.
An incredibly sharp contrast to Meta's cash drain, Microsoft's fourth-quarter report proved that disciplined AI investments can absolutely yield immediate, substantial financial rewards. They delivered what I'd call an absolute masterclass in AI monetization. They generated $90 billion in AI monetization revenue, comfortably beating the $87.6 billion estimate. Earnings per share came in at $4.81, beating the $4.24 estimate, and Azure AI cloud sales surged by 43%, topping the 40% estimate. But honestly, the most critical takeaway? They achieved all of this while surprisingly keeping their Q4 capital expenditures lower than expected at $41 billion, which is below the $42.5 billion estimate, and they maintained their full-year spending guidance at $175 billion without needing to revise it upward.
Microsoft CEO made a statement that perfectly encapsulates this success, noting that they are, quote, pushing the frontier of the cost yield curve, ensuring every customer can convert tokens into business outcomes. He also confirmed that their flagship commercial AI software, Microsoft 365, has already surpassed 30 million paid seats. This kind of rapid, highly tangible adoption proves that Microsoft's massive AI infrastructure investments are already successfully generating enough cash to offset their rising depreciation costs.
So this all brings us to a final, really critical question. As we observe companies like Apple successfully sitting out this wildly expensive AI arms race altogether, the contrasting fates of Meta and Microsoft leave us wondering, how long will Wall Street actually tolerate endless AI spending without immediate returns? The data suggests that while long-term AI monetization is necessary, right now, investors are heavily rewarding financial discipline and immediate execution.